All right. Lana, do you want to go ahead and start?
Yes. Okay, so it's 1 minute past the time. So I guess we can get started. So good afternoon and welcome to the Sage Investor webinar. My name is Lana and I'm a co-founder of Sage Investing Group along with Maggie and Jen. Before we begin, just want to make sure we do quick sound check and a visual check. Can you just type in the chat box if you can hear me and see the presentation deck that will be shared with you today? Okay, great. Thank you. So just as we move through this presentation, if you have any questions, feel free to use the chat box to type in your questions, and we'll reserve a couple minutes at the end of this presentation to go through those questions. Okay. All right, so now let's talk about knowing the tax advantages of real estate syndication. It's tax season, everyone's favorite time of year, right? As they say, there are two certainties in life, and that is death and taxes. We acknowledge that having to do your taxes every year feels painfully excruciating. And you may think you have no choice about how much tax you're having to pay because in some way, everyone has to pay these taxes, right? Not necessarily. There are millions of people who legally pay little to no taxes each year. How, you ask? They just simply understand how tax law works. And yes, tax law can be confusing, and that's why they have tax professionals. But if you understand the basic principle about why tax codes are written as they are, it may help you figure out how to navigate through the complexities. So the basic principle of tax codes. If you have ever read Tom Wheelwright's Tax-Free Wealth book, and if you haven't, I highly recommend it, he breaks it down this way. In the early year of tax income, only the very rich were subject to taxes, and this was so because it was believed that since the rich had more income than they needed in order to live comfortably, they could afford to pay some of this back to the government. After the government saw that this changed the behavior of people paying the taxes, they began to tinker with the tax law and found that a minor change in the tax law could have a profound effect on the behavior of the people. If the government gave tax incentive to invest in business, more people would invest in business. If they gave a tax benefit to those invested in oil and gas, more people would invest in oil and gas. So the tax law grew from being a simple revenue-raising vehicle to an array of laws that govern the economic activity of the land. And so understanding a tax law is really a tool that the government's using to shape the economy and promote social, agricultural, and energy policy. In the US, 95% of the tax code is actually intended not to raise taxes, but rather stimulate the economy. In fact, the tax law is a map to vast amounts of wealth. It doesn't just show you how to reduce your taxes, but if you follow the law carefully, you find fundamental principles to amass cash flow and wealth. Because again, the government's wanting the economy to grow. It wants you to invest in local energy production. It wants you to invest in local agriculture. And it wants you to invest in economic activities that provide housing and jobs for people. Tax planning can and should be used in your wealth strategy, which is why we felt this topic was something we wanted to cover as a real estate investor in syndication. So that's the context of today's webinar. I'm going to pass the presentation over to Jen to cover the next slides. Jen?
Thanks, Lana. Now that you guys know why we're not fearful of taxes, I just want to do a little introduction about us. All three of us, we hail from the Big Four accounting firms. So our background is rooted in audit and risk management. And I know people usually run the other way when they hear that word audit, but we promise that we are on your side in this situation. We are essentially using our combined 35 years of professional experience in audit, accounting, and finance, along with our real estate investing experience to do what we do now in multifamily syndication. And that is we present deals to you that we have been critically vetted by all three of us so that busy professionals like you can invest with greater confidence in these multifamily syndications. So our group today, we have over 180 members in our investor circle. and we have over 450 followers on Facebook. Collectively, we have participated in 14 deals across the US, totaling over 3,000 multifamily units, and with a portfolio size of over $350 million. So obviously, we believe in multifamily, and we also believe that multifamily is one of the best asset classes out there. So we've created this webinar series to provide you guys educational content to help you decide if this is the right investment strategy for your life as well. So this webinar is really good for anyone who tried to invest in syndications before, but ended up backing out, or you've invested in syndications before, but maybe you felt like you didn't really know enough about it, but you still dove in. And then we also for anyone who maybe feels overwhelmed by all the information that's out there. And so before we jump into the content, I just want to put a little disclaimer out there that this webinar is for your educational purpose. And although we all have a CPA background, Sage Investing Group, we're not a legal, financial, or tax advisory firm. So do please consult with your respective professionals for those type of questions. And also during the presentation, we'll be sharing a few numbers purely for illustration purpose. Please know that we cannot guarantee any returns. And as you know, there are risks involved in any investments. So after today's session, we hope that you walk away knowing what the 5 tax considerations are for investing in real estate syndications and how they may impact you as an investor. And then lastly, we will discuss 2 common options for investors when an asset is sold and the tax implications of each option. So just a little warning, it's a lot of information that we're going to share with you guys today. So it might be helpful to listen to this presentation twice if some of the things might go over your head a little bit initially. So the 5 tax considerations that I just mentioned we'll be discussing today. The first 3 are all related to depreciation. So they are depreciation, cost aggregation, and bonus depreciation. And we want to highlight the different methods of depreciation that's available to the investors and how they benefit you as a limited partner in these syndications. And then the last 2 considerations are depreciation recapture and capital gains, which are 2 considerations that may have a tax impact on your investment upon sale. So these are very important factors to keep in mind as you start investing in syndications. And now Maggie will kick us off on the topic of depreciation.
Thanks, Jen. So, hey guys, we're going to talk about depreciation. So let's define what it is. It's a deduction of property losses of value over its expected life from normal wear and tear. So for those of you who do not have an accounting background, you can think of it like when you are buying a car. As soon as you drive it off a dealership, you know it depreciates in value and you won't be able to sell it back to the car dealership in the same price that you bought it. And if the car is a personal property, you won't be able to take the tax advantage if your car depreciates in value. Now, as Lana mentioned, the IRS code is written in favor to allow businesses to take the depreciation deduction in order to stimulate the economy. And in this case, in real estate syndication, it's both a business and real estate asset. As it applies to apartment investing, the IRS allows a standard straight line depreciation method. So a residential rental building, it can depreciate over 27.5 years. And just to share an example, so assuming we buy a building for $10 million, the annual depreciation expense or deduction we can take is $10 million divided by 27.5 years, or $363,000 per year or depreciation deduction. Now, if in the world of real estate syndication, where we pool all the invested money together to buy these apartment building, the depreciation deduction is deducted from the net operating income, and it can be more than what the property is actually making that year. That is why you can technically make a profit, but because of depreciation, the property will look like it's actually at a loss. Now, 3 things to keep in mind. Number 1, the purchase price in this example, is $10 million. But normally in real estate syndication, a property is purchased through a loan with 75% leverage. So in this example, we will buy a property at 25% down payment. That's about that's $2.5 million. And 7.5 million is borrowed money from the bank. The real kicker here is the depreciation is based on the actual purchase price at $10 million. So that's the beauty of depreciation with leverage. You can actually buy a property at 2.5 million, but you're actually getting depreciation deduction benefit of a $10 million property. So, and number two, these losses does get passed through to your to the investors in their K1 schedule that they get at the year end. And three, so as an investor, you get this K1 schedule and it shows a loss. So what does that really mean? For most of you who are busy professionals with an active W-2 income, you will probably not be able to see this net loss, which is considered passive losses. You cannot net it with your active W-2 income. This passive losses will basically be suspended until you have an income in the passive activity or upon the end of the investment. And we'll discuss this more in details later. But we'd like to share the second leg of this is cost segregation. So cost segregation is defined as strategic tax planning method that identifies all parts of the property that can be depreciated in a shorter lifespan, like 20 years, and accelerate them in the earlier stage of the project. It's like cranking up the depreciation deduction. So instead of applying a one-size-fits-all method, a straight line depreciation, we know that not every asset in the building is actually not created equal. So different assets are assigned different useful lives based on the IRS code and guidelines. For example, carpets would have much shorter useful life than the roof on the top of the building. So in order to unlock this benefit of cross segregation study, we do have to hire engineer, and we ask them to itemize and categorize each individual component that makes up a property. So such as wiring, window, carpeting, and fixtures. Then each of these assets are assigned a useful life of 5, 7, or 15 years. So let's go to share a example of that. So 1 second. So using the same example, we purchased a $10 million property building, and we conduct a cross segregation study. And we found that of this 10 million, 4 million is actually related to wiring, window, carpeting, and etc. That can be depreciated a shorter lifetime of 5 years. This means that the 6 million is actually related to the actual building and will still depreciate over 27.5 years, or it comes out to $218,000 depreciation per year that you can deduct. The 4 million, we can depreciate over 5 years, or $800,000 of depreciation per. You can get $800,000 depreciation per year for the next 5 years. So, which this means that in year one, this makes up the total depreciation come up to a little bit over $1 million. So the 218,000 depreciation plus the $800,000 depreciation will get you to a little bit over 1 million, which is a little bit more, which is a lot more than the $363,000 straight line depreciation method. And it is fairly easy and cost effective to do it on multi-million-dollar apartment building. The cost segregation can apply to a real estate that has been constructed, purchased, or expanded, and remodeled. And it accelerates your depreciation deduction, so you can use it more sooner to offset your passive income or project on this project or elsewhere, and ultimately deferring or reducing your investment income taxes. And because these are actually paper losses and not real losses from the operation of apartment building, this is why you can still get a distribution even though your K1 shows a loss. So let's crank it up a little bit more. So bonus depreciation. So now this is probably the most attractive factor out of the other ones we just shared. So bonus depreciation is a tax incentive that arose from the Tax Cut and Jobs Act of 2017. And allows the business to take 100% bonus depreciation on qualified properties purchased after September 2017. And it allows an investor to recognize more of the losses in the first year of the asset than that's categorized with a shorter useful life. It's like putting depreciation deduction on steroids. So now, under the current law, the bonus depreciation doesn't last forever. There is a phase out in steps. So starting in 2023, the bonus depreciation will decrease to 80% and further step down by 20% per year until it's completely phased out in 2017. So let's go back to the same example that we had before. So using this previous example, right, we purchased a $10 million property. We conducted a cost segregation study, and we found that of the 10, 4 million is related to wiring, window, carpeting, etc. That can be depreciated in a short lifetime of 5 years. So same thing again, this means the 6 million is related to the actual building and will be depreciated again at 27.5 years or $218,000 depreciation deduction per year. Now the 4 million, now that this is identified having a useful life of 5 years, can actually, under bonus depreciation, we can take it 100% in year one. So which means ultimately in year one, your total depreciation is equal to $4.218 million. So I hope I was able to get you guys all excited about taxes. So before I turn it over to Jen, just wanted to share one last point about depreciation. Unlike a car, if you think about the value of a real estate, it doesn't really literally depreciate. So if you buy a property at $10 million, in a few years later, that property will likely appreciate in value. And this is why real estate is so attractive. It reduces the amount of taxes paid on assets, but also appreciate in value simultaneously. So some food for thought. Now I would like to turn it back to Jen.
Sorry, thank you so much, Maggie. Now, what Maggie shares sounds really great, right? Well, before we get too excited and think that real estate investing is 100% tax-free, let's talk about how and when the IRS gets their share of your investment profit and what you can do about it. So, as we had mentioned in the beginning, there are two main taxable components for your investment in real estate syndication. And these are the depreciation recapture and capital gain. I will go ahead and explain depreciation recapture, and Lana will explain the capital gains, but we will explain what each component means, and then we will illustrate using a simplified made-up scenario to kind of make it more clear to understand. So let's just assume the following, for our example, that you are an investor and you invested $100,000 into a syndication. And the syndication has a whole period of 5 years. And for simplicity's sake, we're going to just assume straight line depreciation. So you are going to receive $16,000 in annual depreciation a year over the course of 5 years. And at the end of 5 years, the property sells and you get a total investment return upon sale of $210,000. But remember, $100,000 of that is your initial investment. So your total gain, total profit is really $110,000 of that investment. So then assume that based on your income and tax filing status, you have a capital gains tax rate of 15% and that your depreciation recapture tax rate is 25%. So given this scenario, depreciation recapture it occurs, like we said, upon the sale of a syndication at the end of the business plan. So that would be usually 5 to 7 years. So while Maggie had highlighted why depreciation is so great, keep in mind that the depreciation, it does reduce the basis of your initial investment over time. So what I mean here is that you invested $100,000 in the beginning, and then over the course of 5 years at $16,000 depreciation per year, you're being allocated that $16,000 of depreciation each year. So on your K1. So over the course of 5 years, that would add up to $80,000 in depreciation expenses that has been passed off to you as a tax benefit to offset other passive incomes. So every time it's distributed to you, it reduces your cost basis. So after 5 years, instead of a $100,000 cost basis, which is your initial investment, you take that, you subtract $80,000, and your new adjusted cost basis is really $20,000. So the IRS knocks on your door at this point upon sale because you have to recapture the depreciation that you took as a tax benefit during the investment hold period. So now Uncle Sam wants a piece of that back. And this is what we call a depreciation recapture event. And like I said, the depreciation amount is simply the difference between initial investment and what the adjusted cost basis is at the end of 5 years. So it sounds bad, but there are actually benefits to this. And the benefit is that the tax rate that you have to pay on this $80,000 is capped at 25% for real estate. So at 25%, that is typically lower than most people's ordinary tax rate. And if you plan well, you can also reduce your taxable amount of your depreciation recapture with any suspended losses that you may have carried forward throughout the years. So what I mean here is that let's say that, as Maggie mentioned, you're a professional, you can't really use this depreciation throughout the life. So you kind of hold on to it and it gets suspended. And every year that you get a depreciation expense, it accumulates. So then if you don't use that throughout the 5-year period, when you sell the property, you can use that $80,000 of suspended loss to essentially offset this depreciation recapture. So it brings it down to zero. 80,000 minus 80,000 is zero. So that means that you can essentially reduce your tax liabilities with that at sale. So you don't have to pay that 25%. So I'm going to pass it back to Lana, who is going to talk about capital gains.
Thanks, Jen. So the impact of the tax impact of capital gains is going to be very similar to depreciation recapture. It's also going to occur upon the sale of the syndication. And what capital gain really is, it's the profit that you're making from your initial investment, or in this case, 110,000, like Jen mentioned. Again, that's just a difference between what the sale price of 210 minus your original investment of 100K. Now, this capital gain, IRS classifies this profit as a long-term capital gain. And the benefit of classifying it as a long-term, it's that at its highest, a rate of 20%, it's still going to be lower than most individuals' ordinary income tax rate. I'll show you in a little bit what those capital gain tax rates are for the taxable year 2020 and 2021 for a given income level and filing tax status. But before I get into that, I just wanted to highlight, similar to the depreciation recapture that Jen spoke about, you're also able to reduce that taxable amount of your capital gain with any suspended passive loss that you might still have remaining. So here's just want a quick overview of what the capital gains tax rate are for 2020 and 2021, in case you're curious which rates apply to you. Most of our investors typically fall under the 15% capital gains tax rate, which for the year 2020, it's for income of $40,000 to $441,000 if you're single. And if you're married filing jointly, that's $80,000 to $496,000. So it's a pretty big range, as you can see. So now let's talk about exit options and the tax implications of each. There are two options that a limited partner investing in a syndication can employ when their asset is being sold. First, you can just take the profit that you got from the investment and pay the capital gains tax on it, which, as discussed, is still likely going to be lower than most people's ordinary income tax rate. But another option that most investors utilize for their investment strategy is using the sale proceeds from the sale of this investment and reinvesting that to a new deal in the same year. That way, the passive losses, through the bonus depreciation that Maggie covered, can be utilized to offset the capital gains recognized on the deal that you just sold. This is how real estate investors are continuing to build their equity and grow their wealth. So just as a quick recap as we conclude, just wanted to cover 3 things. First, the tax code favors real estate investors. 2, depreciation is a powerful tool. Cost segregation, bonus depreciation, they're depreciation on steroids. And third, capital gains and depreciation capture are things you can plan for. So we started this webinar with the old adage that there are 2 certainties in life, death and taxes. While death remains a certainty, unfortunately, taxes are somewhat manageable if you plan it right. It's like your relationship with money. You have to have a good understanding of how money works to have and be financially comfortable. Similar to that, you have the good understanding of taxes so that Uncle Sam doesn't have to be your greatest foe come every tax season. With that, Jen is going to close us out.
Thank you so much, Lana. Great recap. So now we are going to answer any questions that you guys may have about the presentation. If you guys have anything, just go ahead and type them into the chat box. And I know sometimes it takes a while, so we're gonna, while we wait for these questions to come in, we wanna ask that if you found this webinar to be helpful, and you know of someone that might be interested in learning more about real estate syndications and investing in them, we would really appreciate it if you guys can refer them to us. And you can even invite them to join us on our future webinar series. So whether you are part of our group already, and if you're inviting other people to join as well, they can join by going to our website at www.sageinvestinggroup.com/join-now, and they simply need to fill out a questionnaire and set up a call with us so that we can chat with them and see if what we have to offer is a good fit for their investing strategy. But if they just want to come and check us out and hear what we have to say, I think inviting them to these webinars is a great start. And the Investor Circle is a community that we've built, and it's really great for anyone, whether you are new to investing or you've been doing it for years, whether you're doing this on the side or this is what you do full time. And it's even for existing passive investors that have invested in other deals already, or even if you haven't invested in any. So with that being said, if there are any other topics that you guys want to see us cover on future webinars, go ahead and email those suggestions to us at info@sageinvestinggroup.com. And with that, that is pretty much a presentation. And we're going to check to see if we have any questions. I see something in the chat box. So ladies, Barry asked, are you taxed based on the location of the property? So you are liable for state income tax as well? Or is the Schedule K based on the incorporation of the LLC? Do one of you guys want to take that? Or
I think I'm trying to understand Barry questions.
Mhm.
So the Barry thing you mentioned, like, so the property itself has its own property tax, right? So the property is held by an LLC, and the property tax is going to hit that bottom line. And then once and after depreciation losses, that's when it's going to transfer, whether it's most likely it's a loss in the first year because of the depreciation. It's going to be allocated in the K1 schedule, and it's you're going to receive it as a partner. It's a partnership share, so off that loss. And what you're going to take that, it's a passive activity. So it's almost like you're investing in a stock that it doesn't matter where the company is. So you're receiving this, and you just want to translate into your 1040 individual. So I hope that it's clear. So, or is there no way to answer the question, Barry?
Okay, good.
Okay, good.
There's his question. Does anyone have anything else?
But of course, consult your tax accountant. Disclaimer.
Well, I guess if you don't have any other questions, that's perfect timing because it is now, I think, are we 30 minutes into our presentation?
It is exactly 12:30.
Perfect.
Perfect timing. So if you do have questions, but you think of it later, just feel free to email us. We're happy to kind of jump on the phone and go through them as well.
Yeah. And yes, it was a lot of material that we covered today, but like I said, I think if you listen to it again, it will probably make more sense. So thank you so much, guys, for attending our webinar today. We hope to see you again on future webinars. Take care.
Thank you.